Unit 4. The Theory of Double Entry. Session 1. The Double Entry Principle for Recording Assets, Capital, and Liabilities. By the end of the session, you should be able to state the rules of debit and credit for the statement of financial position items and identify the account to be debited and the account to be credited in transactions involving assets, liabilities, and capital. When a transaction occurs, elements of the financial statement are identified and changes occur in them. For example, assets, expenses, liabilities, gains, and capital. Every transaction has two aspects to it: the dual effect, one giving and another receiving, an inflow and outflow, an increase and a decrease. Both aspects must be recorded in the books through the double entry system. The double entry theory states that for every debit entry, there must be a corresponding credit entry and vice versa. That is, for every debit entry, there must be a corresponding credit entry and vice versa. The double entry rule is applied in accounts which are kept in a ledger. Thus, postings are made from the journals to account in the ledger. Posting is simply recording transactions from the journals into the account in the ledger. An account is a dedicated record of increases and decreases in specific items of assets, liability, capital, gains, expenses, etc., and the balance, if any. Accounts are normally kept in a T form, with the left-hand side known as the debit and the right-hand side known as the credit. The account provides the date, particulars, ledger folio, and the amount involved in the transaction. So this is an illustration of an account. The left-hand side is known as the debit, the name of the account, and the right-hand side is known as the credit. Double entry rule for assets. Accountants increase assets by debiting assets account, and they decrease assets by crediting asset account. In other words, all asset accounts are increased on the left or debit side and decreased on the right or credit side. So on the left, we enter original amount on this side and enter increases on the debit side, whilst we enter decreases on the credit side. So to debit an asset account means to increase their account, and to credit an asset account means to reduce the account or to record it on the right hand side. Double entry for liabilities. If accountant wants to increase liabilities, they enter the increase on the credit side of the account, and the reduction is shown on the debit side of the account. That is, for liabilities, to debit means to decrease the balance on the account, whilst to credit means to increase the balance on the account. Double entry rule for capital. The capital account, like the liability account, is increased on the right side or credit side and decreased on the left side or debit side. So when we record things on the left side, it means that there is a decrease. So we enter decreases or reduction in capital on the left side, whilst on the right side, we enter increases in capital, or we credit increases on the capital account. In a nutshell, for assets, expenses, and losses, increases are debited while decreases are credited. On the other hand, liabilities, capital, and revenue, increases are credited while decreases are debited. In this session, we stated the rules of debit and credit for the statement of financial position items and identify the account to be debited and the account to be credited in transactions involving assets, liabilities, and capital.